Hi, Woody here for the Insider. Now, I dragged Murray and Greg back on camera today because I thought we could follow on from the number of conversations that we've been having lately about whether we are approaching a turning point. It's kind of weird though, because the first time we had this chat, it was around 4 to 5 weeks ago, and we've had ups, we've had rallies, we've had crashes, and we're almost back to the same point we were when we first started having the conversation. So I just thought, rather than cover that same ground, perhaps we can look a little further out. So I thought that's why I'd start with you, Greg. We were chatting this morning just before this call. You're kind of looking a bit further out to September because the consumer spending figures, the near-term consumer spending figures in the US have come out a lot stronger than expected. That they're stimulating like crazy. Well, I think it was 6 trillion now in what is essentially artificial government support. But you're looking out to September as being a pivotal point. And I believe you put a short on. So I thought you could kick off the conversation by explaining why and what you're seeing that far out.
Yeah, no worries, Woody. Yeah, look, there is a lot of stuff going on in terms of, liquidity and stimulus. And I think that's a big part of the reason why we've seen the market move so fast so quickly. And that's been the theme of our discussions the last couple of times we've met is, how long can this continue to go on? When will the market sort of retrace a lot of these gains we've seen purely based on central bank support, government support? And you're right, between the Federal Reserve's balance sheet expansion and Congress stimulus efforts, we've seen $6 trillion going to the US economy in just the past few months. So of course that's going to translate into these huge share price gains because, where else is the money going to go to? So what I'm sort of looking at, we've been talking about these potential turning points, and what I'm sort of wondering is at what point will the market start to look forward a few months, and how will they interpret the withdrawal of some of this stimulus? So, a few of the things just for the Aussie market, for example, a few of the things I jotted down that is going to be approaching in the next couple of months. We've got free childcare ending on the 12th of July, and the JobKeeper payment is ending for childcare workers very shortly as well. At the 7th of June, there were 500,000 mortgages worth 172 billion that had been deferred. So those payments deferred frees up money to spend elsewhere. And of course, a lot of that money will be going into consumer discretionary purchases. By the end of September, or at the end of September, a 6-month moratorium on residential and commercial evictions will end. So that means, reality is going to hit a lot of people who haven't been able to afford to pay their rent. They're going to have to do something about that at the end of September. JobKeeper payments could be wound back before the September end date. The government's already started to talk about that. And as you spoke about a little earlier, there's as the economy opens up and the job positions are opening again, especially for I guess, the retail worker and cafe and casual workers and things like that. A lot of workers are reluctant to go back to work because it's better for them to stay at home and get a larger JobKeeper payment. So the government is going to have to pull away some of this stimulus spending. And of course, also at the end of September, you've got the $550 coronavirus boost to New Start payments disappearing as well. So there's a lot of money that's going to start to exit the economy. And for me, I'm sort of looking at a lot of these consumer discretionary stocks that have outperformed massively. They've had very, very strong runs over the past couple of months. And if I see them start to turn down in the weeks ahead, then that's going to be a suggestion to me that, perhaps this very quick rebound that's probably better than a lot of people expected, we're going to see a bit of reality hitting in the next few months. So that's really what I'm looking at is what does the world look like when there's less support for the economy and for stock markets.
Do you think they'll actually let that happen though?
Well, I guess it's not a case of letting it happen. I don't think they're certainly not going to pull that support in one go, but they're going to ratchet it down. And of course, whatever the way stock markets react, it's all about the rate of change. So if the rate of change starts to drop just slightly, that's going to have an effect on stock prices. So and as you mentioned before, that's why I put a short on the ASX 200 just yesterday actually. purely because I thought, well, if there is going to be a turning point in this market, it's going to happen pretty soon. If I'm wrong, the risk reward ratio is pretty good. So if I'm wrong, I'm not going to lose too much money. If I'm out, if I'm right, sorry, it's going to do very well. I think Murray's probably on a similar thought pattern to that. So look, I think, we've been talking about turning points. If we get one, it's going to be pretty soon.
Murray, what are your charts telling you about that then? Because I know in Wednesday's Insider, you were talking about the fact that if bond yields aren't allowed to rise and the money printing continues, we're in for a pretty inflationary period. You're on mute, Murray, by the way.
I've been muted. There you go. Look, do I know that inflation's coming down the pike? I don't, because inflation's been something that we've had our eyes on for the last 10 years and it's never shown its head, has it? So it'd be a pretty big call to come out and say that that inflation's coming. But I just think there's a lot of talk about the Fed possibly doing yield curve control, and that would be actually putting their foot on the long bond. So like the 10-year sort of yield, an area which they haven't really had control over. But of course, if they're keeping rates near zero, they've had an effective way of managing the long bond, and they have been buying the long bond with QE. But here is where they're saying that they're going to actually say, no, it cannot go above this level, which is price fixing. And that's price fixing at the core of asset markets worldwide, which is the government debt markets in the US, which is such an important pricing mechanism for everything. So that step, if it's coming from the Fed, I think is a very big step, and ultimately negative. It may work for them initially, but I think once you say that your long bond cannot rise at all, and then you're issuing trillions of dollars from Trump to try to get re-elected, to spread as he can, and the Fed is buying all of that debt with printed money. If you can't see that from a pretty rational perspective that that's going to lead to problems down the pike, for me it really stands out as something that can end up being an inflationary kickoff. And the first signs of that will be with gold really shooting. I think everything's just pointing to whatever happens from here. Gold is looking pretty solid, and it's been solid even though markets have been rallying. Gold's been holding up near its highs. You'd think there'd be a bit of selling based on taking away the safe haven aspect of gold, etc. But it's just been holding in there, and I think it's a big picture. Possibly we're getting closer to that point of that massive bust out in gold, where they're really starting to stuff with things. But as far as the markets go, I got short yesterday. I basically bought lots of puts. I very rarely do that sort of thing, and went short the US market, and I sold out of stocks last week before that big sell-off, where Dow fell 7% in the night. I mean, you say that the market is at a similar point. It's at a similar point, but a lot has actually happened where you've had the big selling that I've been talking about coming in at the sell zone of the wave in the crash. I mean, that came in where I expected it, and it was big. So that's the big picture selling that I've been waiting for. And this rally in the last week has really been just shaking out the short-term traders who've been trying to get short. And now it's starting to turn back down again. For me, the setup is something that I very rarely see. And it's after the fastest crash in history. So for me, I'm sort of really on tenterhooks. And I said in my update yesterday, this could be the trade of the year. I'm basically thinking if the momentum shifts back down here and the 200-day moving average is not far below here, if that cracks, I think the market can really get pounded quite quickly.
So are there any other sectors or things that you're actually long in, or is it just gold?
No, I'm long. I'm long a bunch of stocks. I've bought some internet retailers. I'll even just have for my own benefit, so I'm getting it right for you. Look, I've even bought media companies and taken profits. Even smaller cap companies in different sectors. But I've basically taken part profits in them. And I'm sitting back and my stop loss is at a point far enough away where if the market does get pounded, and we get taken out, we'll have no loss. So I'm really treading carefully as far as my longs are concerned. But, you know, we know the amount of stimulus that's happening. Who knows? It could keep going to the upside. So I'm wary, you know, but what's my overall portfolio? Probably pretty market neutral. I've gone short all of that, and I'm long stocks. And I think the US market's going to get hammered, but there are stocks that I like long term. So look, it's a very tough environment due to all of the constant intervention and the aspect of, is there going to be a second wave? And we're seeing things happening in Beijing with the virus. We're seeing things in the US states that are starting to pick back up. Look, it's a pretty dynamic environment. But right now, my charts are basically saying it's one of the best opportunities for me to get short in the short term.
Traded, yeah, that's a good one. So, hey, Greg, so you got a short one, but you also mentioned a play in the US dollar as well.
Yeah, I mean, that's another, I guess, form of a market hedge. I mean, even though the US is printing, you know, loads of dollars like every other central bank around the world, in times of stress, the US dollar does get stronger. And I think the Aussie dollar has had such a spectacular run, and the Aussie dollar, I think, will have trouble sustaining that run, given that we're not really in a global economic expansion. So, you know, my view is that that run is effectively over at around the 70-cent level. So I put on a buy US dollar position around there. So if this, and just to sort of give you some context, longer term, I'm reasonably bullish on stock markets, and there's a lot of stocks in the Aussie market that are reasonably good value. Shorter term, I'm concerned purely because of the liquidity that has buoyed prices in the short term, and we're not really sure what some of these stocks and earnings are going to look like once a lot of this stimulus moves back out of the market. So long-term bullish, short-term bearish, and just to sort of I guess create a bit of a profit opportunity around that short-term view, long US dollar and short the Aussie market, just to try to have some profit opportunities. But I think if we do get a solid pullback from here, it'll be a really good opportunity to pick up some stocks that are showing, you know, reasonably good value. So it's not, for me, it's not all bad. I think there's plenty of good things to look at, but based on the amount of intervention that we've had, you just need to be a little bit nimble about the way you look at things, because this, you know, the volatility that creates does mean that stock prices can move very quickly and it, you know, quite a lot in a short space of time. So you really just need to manage that potential volatility and not sort of get into a position too quickly when you think that there's a shorter term risk.
So that's been really interesting. So I think I thought we could like end on a more of a different slant of a question, more macro sort of question. Greg, are we approaching, forget the welfare state, are we approaching the welfare world right now? Like where it gets to a point where it's more profitable just to literally stay at home than actually go to work because the government's got your back?
Yeah, look, I mean, you're seeing so many examples of that. And it's not just this, you know, COVID-19 thing that's brought it out. I mean, we as a society, we've been lurching to the left and to the welfare state for many years now. And if you look at what a lot of these protests are about, and young kids coming through with their ideas about how the economy works and their sort of cheerleading for socialism, it's a real concern about the way the world is going. But at the end of the day, you cannot get paid by printing money and doing nothing. There will be some sort of feedback loop that just tells the world this is not how things work. I mean, we all know that, you know, you get paid from working hard, adding value. So really, if everyone wants to sit home and do nothing and get paid by a government printing press, that's when inflation starts, because nothing will be produced and there'll be more and more printed dollars chasing those fewer produced goods. So that's really the outcome of that sort of mentality. And, you know, as the saying goes, you reap what you sow. So if that's what we think is, how the world should work, then we'll certainly, be shown that that's not the case.
Yeah. And Murray, I guess we'll end on you because we got a Pivot Trader opening up next week for a new wave of people that want to try it out. Have you got any final remarks, any final thoughts, what people should be looking for next week?
Next week, well, yeah, I mean, like I just said, I'm currently looking at this market as one of the best opportunities I've seen in a while to get short. I think we can have a pretty quick, sharp 10% correction even. 2,800 is my initial target in the S&P, which is the midpoint of the whole crash. So usually markets oscillate and return to the midpoint because that shakes everyone out, bulls and bears. So if we do turn back down, I think it can be a pretty sharp move to there. And I'm basically setting up trades so that I can take advantage of that and then hopefully make money, whatever happens from there. I sort of want to get myself into cheap straddles, they're called. So I'm sort of buying out of the money puts, market will get there, take half profit, buy calls, and create a straddle. And then from there, I don't really care what happens. Clients will make money either way.
Yeah, there you go. Well, thanks, guys. I think that's a good place to wrap up, and we'll have more for you next week. Cheers.
Cheers.
Thanks, Woody.